Welcome to my channel today. Are you tired of feeling overwhelmed by financial jargon and numbers? Do you want to understand how to read and interpret financial statements like a pro? In this video, I will introduce you to the world of ratio analysis and show you how to unlock secrets of financial statements. Let's go. What is ratio analysis? Ratio analysis is a powerful tool used to evaluate a company's financial performance and position by calculating and interpreting financial ratios. Ratio analysis is a powerful tool used to evaluate a company's financial performance and position by calculating and interpreting financial ratios. So, classification of ratios. Classification of ratios. For our purpose, we shall categorize ratios into 5. Number 1, we have profitability ratio. Profitability. Or performance ratios. Performance ratios. Profitability ratios or performance ratios. Number 2, we have liquidity ratios. Liquidity. And the third one, we have debt ratios. Debt ratios. The fourth one, we have investors ratios. Investors ratios. And the fifth one, we have working capital ratios. Working capital ratios. For our purpose, we shall start with the profitability or performance ratios. What is performance ratios? Performance ratios are financial metrics used to evaluate a company's performance and position. Performance ratios are financial metrics used to evaluate a company's performance and position. Performance ratios can also be called profitability ratios. By profitability ratios, it means one of the variables used in calculating these ratios is profit. That means profit is used as a measure of performance. That is why the profitability ratio is also called the performance ratio. So, one of the variables used in calculating any of the ratios we have under these categories is profit. So, under the performance ratio, we shall look at 1, the gross profit margin. Gross profit margin. Gross profit. It means the profit used as a performance measure here is the gross profit. So gross profit is used as a performance measure. It measures the company's profitability after direct cost. Remember, cost of sales is a direct cost. So it means your revenue less direct cost will give us the gross profit. Revenue less cost of sales will give us the gross profit. That is why we said it is the profit after direct costs. Therefore, gross profit margin equals to gross profit over revenue. The profit after direct cost. So for this ratio, the higher the better for the entity. So the entity we want to achieve sufficient gross profit. Sufficient profits that exceed the direct cost. They should be able to have a sufficient profit. So the higher, the better. So there are a number of reasons why these ratios might rise or fall. Number 1, you have to look at the pricing strategies. the pricing strategies might positively impact the revenue. So the number, if you want to look at the probable reasons why the gross profit margin might have risen or might have fallen, the reason could be pricing strategies. Pricing strategies. This could have a direct impact on the gross profit margin. If the pricing strategy is favorable, the gross profit margin might increase. But if it is not favorable to the entity, it might have an adverse effect on the gross profit margin. Another factor that might cause an increase or decrease in gross profit margin is direct cost. Direct cost. Where direct cost rises, then the gross profit margin might fall, or vice versa. So it means your comment or even your recommendation should center on these two major aspects. Your recommendation or your discussions on gross profit margin, your recommendation should center on pricing strategies or the effect of the direct cost on the profit margin. Then the number two ratio I will consider that can be used in measuring the performance is the net profit margin. Net profit margin. By net profit, it means profit after all expenses have been deducted. It is profit after the deduction of all expenses, including tax. After tax have been deducted, that means the profit you use here should be the profit after tax. Profit after tax. After tax part. That is the profit to use whenever you are calculating the net profit margin. The net profit margin measures the percentage of sales revenue retained. It measures the percentage of sales revenue retained as net income. How much of the sales revenue is retained as the net income? That is what this shows. It measures the percentage of the sales revenue reported or retained as the net income. So, to calculate the net profit margin, we have the profit after tax, that is your part, over revenue. Margin is sales. Over revenue times 100 over 1. That is the net profit margin. For this ratio, the higher the better. The higher the better. There are additional factors you need to consider, you need to look into that might have a bearing on this net profit margin. Those factors could be direct and indirect costs. Direct costs which have been considered when calculating the gross profit margin. Then indirect costs which have not been used. Your administrative expenses, your distribution expenses, or every other expenses you have. You can have them as indirect costs. So these indirect costs might have an adverse or a favorable impact on the net profit margin. Where it have impacted or where these costs have a positive impact on the net profit margin, the net profit margin might increase. So now your discussions, your recommendation should be that the entity should apply a proper control measures. Where it is not favorable, they should control their costs. Where costs are controlled, where adequate control measures are in place, then the net profit margin is expected to rise. The third profit we consider is the operating profit margin. Operating profit. Operating profit margin. Operating profit margin. Operating profit margin measures operating income as a percentage of sales. It measures the operating income as a percentage of sales revenue. For this ratio, the higher the better. It measures the operating income as a percentage of sales revenue. And your operating income is your EBIT, earning before interest and tax, or profit before interest and tax. Therefore, your operating profit margin will be equals to the profit before interest and tax over revenue. Profit before interest and tax over revenue times 100 over 1. It means your discussion on this ratio, those things that would impact this ratio could be your operating expenses, or your indirect expenses. So those one, we also have direct, because direct is part of gross profit. So your operating expenses, so your discussion here is similar to what you have here. The only difference is that we did not consider tax, we do not consider interest when this one is calculated. But the interest and taxes have been taken into consideration in calculating the net profit margin. So that is the difference. The only difference between the two is the interest and tax that are considered under this, but the interest and tax are not used when calculating the operating profit margin. Number 4 ratios I will consider is net assets turnover, or assets, let me just say assets turnover. These ratios indicate how efficient the entity is in utilization of their assets. You want to know if the assets are used efficiently or not. So that is what these ratios indicate. It means where assets are used with greater efficiency, then you will expect this asset turnover to increase. But if it is not used efficiently, effectively, the asset turnover will decrease. So that is for asset turnover. Then asset turnover equal to revenue over capital employed. This asset turnover can be computed in times. It can also be computed in days. This one is in times. If you apply revenue over capital employed, that will give you asset turnover in times. But if you want to compute it in days, you have asset turnover, that is, let me have this as A. B, asset turnover that will be revenue over capital employed. Times 365 days. So that is assets turnover. But this capital employed, there is no universal definition of capital employed. What is capital employed? These are assets. These are the funds used in financing the business. That is capital employed. The resources used in running the business. The funds used in running the business. That is capital employed. So what is capital employed? Capital employed could be 1. And this number 1 definition is the one I would recommend if the entity is geared. Equity plus debt. And you should always use this definition as capital employed, especially where the entity is geared. That is, the entity is financed with both the mixture of equity and debt. That means the capital they have employed in the business will comprises of equity and debt. That is where a business is geared. But if the business is ungeared, that means the business is financed with only equity. Therefore, the capital employed will be equity. That is why you see some saying total asset minus total liabilities, which is, total asset minus total liabilities is equity. That is, if a company is ungeared, then you have your capital employed to be equity. And this definition is the same as total assets minus current liabilities. But if you have no interest bearing debts as part of your non-current liability, those will have to be removed too. That is why it is better to say equity plus debt. But this debt must be interest bearing debt. Must be interest bearing debt. By interest bearing debt, we mean the portion of non-current liability that carries a fixed interest rate. Those liabilities that carries a fixed interest rate, those are the interest bearing debts I'm referring to. Any liability that doesn't carry a fixed interest rate is not an interest bearing one. So it means the debt to consider must be interest bearing one. For instance, under your non-current liability, you might have 10% loan notes. You might have 5% redeemable debentures, 5% redeemable preference shares. Those are interest bearing loans I am talking about. And some definition could be capital employed equal to total assets. Total assets. But now, the calculation of ROS, that is return on, I'm still on the definition of capital employed. I'm not yet on ROS anyway. So, you could have your capital employed to be what? Equity plus debt. Remember, I've told you the debt here is interest bearing debt. Then you could also have capital employed equal to equity, where the company is ungeared. Where the company is ungeared. That is, the company is ungeared if it is all equity finance. If the company is financed with only equity, the capital the companies have employed is their equity. Then the third definition of capital employed is capital employed equals to total assets. Your total assets could be non-current assets plus current assets. So that is the definition. I've given you the various definition of capital employed, but I've told you I recommend the first definition, especially if the company is geared. But in exams, if you want to make use of capital employed, you check the source of finance. Is the company geared? Is the company financed with the mixture of equity and debt? If your answer is yes, then you use the first definition. Is the company ungeared? If the company is financed with only equity, then that means you use equity as what? Capital employed. And where you are expected to use total assets, it may be stated in the question return on total assets, or they might ask you to use total assets. It may be stated. And if it is not stated, if you adopt it, though the three definitions will give you different answers. So this is capital employed. Then that is all about assets turnover. The number 5 ratios I want to consider is return on capital employed. I've explained what capital employed is or are. And now I want to talk about return on capital employed. Number 5. We have return on capital employed. Remember, I've given you the various definitions of capital employed. ROS. I've told you if the company is geared, that means the business is financed with equity and debt. So if you say returns, we are talking about profit. That means the profits to use where a company is geared should be the profits to the two sources of finance: equity, debt. The returns to equity is to debt is interest. Then this one is profit, especially profit after tax. So now, if it is the return to both source of finance, that means your roles now will be profit plus interest. That will be profit before interest and tax over capital employed. Profit before interest and tax over capital employed. Remember, I told you where this is the definition you want to adopt, that your capital employed should comprise of equity and debt. That is why we've used the returns to both equity and debt combined. The returns to equity and debt are combined because the definition of capital employed we have adopted in this case is equity plus debt. Then, if this is a return on capital employed, you can also use return on total assets as capital employed, return on total assets. So, your total assets will have also comprised, total assets, based on the concept of capital maintenance, equity, asset equal to equity plus liabilities. That means if you are using total assets, you are combining the two sources of finance solely that the total asset might be greater because your liability also include in current liabilities. So that is what brings the variance between this and this. Your total assets comprises equity and liabilities. So the returns that you have to use for the total asset must comprise return to equity and liability, which is profit before interest and tax. Return on total asset, ROTA or ROA, or if you use return on assets. So I've told you the return is profit before interest and tax over total assets, where you have to calculate return on total assets. So now I want you to note that this capital employed have two legs. There are two legs to rows. Remember, I told you earlier that return on capital employed is a financial metric that measures a company profitability and efficiency in using its capital. Return on capital employed is a financial metric that measures a company profitability and efficiency in using its capital. Two things are involved: measures of profitability. Rows is a measure of profitability. Then the second one is the measure of efficiency. So since it is a measure of two things, remember I've talked about the measures of profitability, which is operating profit margin, and I've equally talked about the measures of efficiency in utilization of the asset, which is which is asset turnover. So that means two things will be used. So this rows, return on capital employed, shows how well a company generates profit from its capital employed. It shows how well a company generates profit, how well a company generates profit from its capital employed. The capital the company is investing in the business, how they use it well in generating profits. So that means rows, now you want to measure two things: the efficiency in utilization of assets and the overall profit. So it means to calculate your rows, your discussion on rows, you have to look at two angles. Rows should never be discussed in only one angle. Two angles, two things are involved. Then operating profit margin. Operating profit margin times assets turnover. These are the two legs of ROAS. It means if you want to use ROAS as a metric in evaluating the performance of an entity, you have to look at it in two angles. Number one angle is overall operating profit margin, and the second one is asset turnover. It means if you want to make any recommendation about ROAS, your recommendations have to be on operating profit margin and asset turnover. So please bear that in mind. What is operating profit margin? I've told you that operating profit margin is profit before interest and tax over revenue. That is operating profit margin. Times, what is asset turnover? I've told you that asset turnover is revenue over capital employed. You see, we have revenue here, we have revenue here. If revenue kills its sister, revenue cancel revenue, therefore, we'll be left with what? ROAS equals to what? Profit before interest and tax over capital employed. Capital employed. It means every discussion about ROAS must centered on these two variables. Number one variable is operating profit margin, and the second one is asset turnover. That is a discussion on ROAS, return on capital employed. Number 6 ratio I will examine is return on shareholders' equity. Return on shareholders' equity. Equity. Some might say, or return on equity. Return on shareholders' equity can be abbreviated as return on shareholders' equity, ROAS, or ROAS, or return on equity. Return on equity, ROE. So, it means what you have as capital employed here is equity. Then, equity are the owners, equity holders are the owners of the business. They are entitled to the totality of the profit from the business after other various stakeholders have been settled. Every other stakeholders must have been settled. Their stake, their own stake have to be met. Their own interests have to be settled before anything can be given to equity holders, since they are the owners. They are the ones that will be settled last. Other stakeholders must have been settled. That is why the profit you need here is the overall final profit, which is the profit after tax. So that means the return to equity is part profit after tax over shareholders' equity. Shareholders' equity or over equity. The equity you have in the statement of financial position, just take the total. Remember, you have equity comprises the share capital and the reserves. That is the return on shareholders' equity. Haven't examined the various performance ratios. Let's solve a question from past exams. Let's go. Example, this question is obtained from ican November 2023 financial reporting question number 2. Shison PLC experienced rapid growth in recent years through the acquisition and integration of other companies. Shison PLC is interested in acquiring Oyowood Limited, a retailing company, which is one of several companies owned and managed by the same family. The summarized financial statements of Oyowood Limited for the year ended December 31st, 2022 are as follows. Amount is given in thousands of naira. The first item is revenue of 70,000 naira. Then we have cost of sales of 45,000 naira. Then we have gross profit of 25,000 naira. Operating costs amounted to 7,000 naira. Director's salaries is 1,000. The total expenses is 8,000. Then we have profit before tax of 17,000. We have income tax expense 3,000. Then we have profit for the year of 14,000. Then we have statement of financial position. So we have non-current assets. And the non-current assets include property, plant, and equipment of 32,400. Then we have current assets, which comprises inventories of 7,500, bank 100. Total current assets is 7,600. Then we have total assets of 40,000 naira. We have equity and liabilities. Equity comprises ordinary shares of 1 naira each, 1,000. Retained earnings 18,700. Total equity is 19,700. Then we have non-current liabilities, which include directors' loans account, interest free, amounted to 10,000 naira. Then we have current liabilities, which comprises trade payables of 7,500, current tax payables of 2,800. The total of the current liabilities is 10,300. Then we have total equity and liabilities of 40,000 naira. Then from the above financial statements, Shison has calculated for Oyowood Limited the ratio below for the year ended December 31st, 2022. It has also obtained the equivalent ratios for the retail sector average, which can be taken to represent Oyowood's sector. We have Oyowood, we also have sector average. Return on equity ROE, including directors' loan account, 47.1% and 22.0% for sector average. Then we also have net asset turnover, 2.36 times for Oyowood and 1.67 times for sector average. Then we have gross profit margin, 35.7% for Oyowood and 30.0% for sector average. Then net profit margin of 20.0% for Oyowood and 12.0% for sector average. From enquiries, Shison PLC has obtained the following information. 1. Oyowood Limited buys all of its inventories from other family companies at a price which is 10% less than the market price for such goods. Note 2. After the acquisition, Shison PLC will replace the existing board of directors and need to pay remuneration of 2.5 million naira per annum. Note 3. The director's loan accounts will be repaid by obtaining a loan of the same amount with interest at 10% per annum. Note 4. Shison PLC expects the purchase price of Oyowood Limited to be 30 million naira, and net assets are equal to equity plus the loan. A. As the financial analyst of Shison PLC, recalculate the ratios for Oyowood Limited after making appropriate adjustments to the financial statements for notes 1 to 4 above. Then we have B. B. Draft a memo for the consideration of the managing director of Shison PLC, commenting on the performance of Oyowood Limited. In a part of the question, the question will find that as the financial analyst of Shison PLC, recalculate the ratios for Oyowood Limited after making appropriate adjustments to the financial statement for notes 1 above. So that means we want to adjust the financial statement. After the financial statements have been adjusted, then we will need to recalculate the ratios given in the question. So we will need to recalculate those ratios with the adjusted financial statements. So now let's adjust the financial statements of Oyowood Limited. We want to adjust the financial statement of Oyowood Limited. So now let's have Oyowood Limited revised. This is requirement A. Revised statement of profit or loss for the year ended. The year end of your wood is December 31st, 2022. December 31st, 2022. By revised statement of profit or loss, we mean the prepared statement of profit or loss after incorporating the adjustments provided. Remember, the amount is in thousand. The first item is revenue. The revenue provided in the statement of profit or loss amounted to 70,000 naira, which is 70 million naira. 70,000. After revenue, the next item is cost of sales. Cost of sales. The cost of sales given in the already prepared statement of profit or loss amounted to 45,000 naira. If you go back to the note, the additional information number 1, you were told that Oyo Limited buys all of its inventory from other family companies at a price which is 10% less than the market price for such goods. Remember, the inventories are the item purchased. In fact, the word buys is used. That means the purchases were 10% less than the market price for such goods. And it means if it is 10% less than market price, because the price has been influenced, because it is a related parties transactions. No, it was from family companies. So related parties, they have influenced the price of the goods. So the amount reported, which is 45 million, will not be accepted. You have to adjust it as if you have to adjust it to its current market price. Remember, the amount given in the statement of profit or loss is 45,000. Now, this 45,000 is equivalent to 90%. So, because it was 10% less than the market price, so it means the amount reported is equivalent of 90%. So you have to gross it to 100%. To gross it to 100%, just multiply by 100 divided by 90, or divided by 0.9. If you don't want to divide it by 0.9, we have 45,000 times 100 divided by 90, because this 45,000 is equivalent of 90%. That is why you will have to divide it by that 90%. Since 90% is equivalent to 45,000, then 1% now will be equivalent to 45,000 divided by 90. And what you need is 100%. 100% now will be 45,000 divided by 90 times 100. This will give you the amount of the equivalent market price of the item. 45,000 times 100 divided by 90, that will give you 50,000. Or if you say 45,000 divided by 0.9, it will equally give you 50,000 naira. So cost of sales amounted to 50,000. By the time you remove your cost of sales from revenue, then you have the gross profit of 20,000. That is our gross profit. Now, after gross profit, we have dealt with note 1. Note 1 has been considered. Note 2, we have after acquisition, Shison PSC will replace the existing board of directors and needs to pay remuneration of 2.5 million naira. The remuneration of 2.5 million will need to be paid by Shison Limited. So that means you were given director's salary in the statement of profit or loss. The director's salary given in the statement of profit or loss will be disregarded. It will be replaced with the director's remuneration of 2.5 million naira. We are going to replace the director's salary of, the director's salary is given to be 1 million in the statement of profit or loss. That 1 million will be replaced by the director's remuneration given in note 2. So we have operating expenses. There are no adjustments to that. We have operating expenses. The operating expenses amounted to 7 million naira. Then directors remuneration. Directors remuneration from additional information 2, note 2. I've told you the 1 million given as director salary will be disregarded since you were told after acquisition, since some PLC will replace the existing director. The directors will be replaced. Replace the existing board of directors and need to pay remuneration of 2.5 million per annum. The amount that they will be paying to the directors that will now be used to substitute the existing one will be 2.5 million. So it will no longer be 1 million. So that 2.5 million will be used. 2.5 million being the director's remuneration for the period. That means the profit you will arrive at will be operating profit. Operating profit in accordance with the provisions in IFRS 18. So 20,000 minus 7,000 minus 2,500. So we have the operating profit of 10,500. So you check it, there is investment income. So if you go through the notes, there are no information about investment income anywhere in the question. So since there are no investment income, that means, so this our operating profit will also be the profit before financing and tax. But if the investment income is there, then the investment income will need to be considered before you can get profit before financing and tax. So note 3, you were told the director's loan accounts will be repaid by obtaining a loan of the same amount with interest at 10%. Remember, if you check your non-current liabilities, you have a loan of 10 million under the non-current liabilities, a loan of 10 million. We have director's loan account, 10 million. And what this note is telling you is that note 3 is that the director loan account will be repaid. This loan, the loan of 10 million will be repaid. And once it is paid, it will no longer be in existence. So now let's see what will happen. The director's loan account will be repaid by obtaining a loan of the same amount with interest at 10%. Remember, this loan is an interest-free loan. But if this loan is repaid, they will now utilize it. They will now obtain another loan again in place of this 10 million. And the loan is of the same amount. That means the loan that will be obtained will be 10 million loans. If 10 million loan is obtained, the coupon, the interest rate on that loans will now be 10%. Remember, the existing loan is interest free, but the loan that will be obtained in place of the interest free loan will attract a coupon at the rate of 10%. It will be 10% coupon. So it means interest will now be payable on the loans that will be obtained. That interest will be 10% of 10 million. So 10% of 10 million will be recognized as a finance cost in the statement of profit or loss. So we have a finance cost, that is interest. Finance cost, which is 10% of 10 million loans, and that will be 1 million. If you subtract the finance cost of 1 million from 10.5, then you'll be having 9.5. This 9.5 million is the profit before tax. Profit before tax. Now, we have considered the note 1, 2, and 3. So note 4 is about Shiston PLC. Expect the purchase price of Oyowood Limited to be 10 million. This is the purchase price. And net assets are equal to equity plus the loans. So this information will only be needed in the statement of financial position. So that means there are no items of adjustment is required in statement of profit or loss apart from those considered. Now, We have the profit before tax of 9.5. So since all these have been considered, then we have income tax expense of 3 million. If you charge income tax expense of 3 million, then you will get the profit for the year of 6.5 million. So income tax expense that amounted to 3 million. If you subtract 3 million, then you have 6.5 million. This 6.5 million is the profit for the year. That is profit after tax. Profit for the year. So we have profit for the year of 6.5 million naira. Now that this has been calculated, now what will be the statement of financial position? Extract. On the basis of the information provided, statement of financial position. So because if you look at the ratios given, we are given return on equity. That means we will need the total equity. Then you are also given the net asset turnover. So you will need the net assets or capital employed. You will need that for this purpose. So then you are equally given the net profit margin. Of course, the information to calculate that have been obtained in the statement of profit or loss. So we don't need any further information for that. Then gross profit margin is equally with, which is gross profit over revenue. The information to calculate that have equally been obtained. So no further information is required. In the net profit margin, the information to calculate that. So we will need the equity, then we will equally need the net asset or capital employed. So how much is the equity now? In the statement of financial position, since you want to calculate the ROE, that is return on equity, how much is the equity provided? In the statement of financial position. So you were told, note 4, that Shison PLC expects the purchase price of Oyowo Limited to be 30 million. The purchase price is 30 million. You know, the purchase consideration, since there are no goodwill, you don't have information about goodwill. Remember, the excess of purchase consideration over net asset, that is goodwill. The purchase consideration is 30 million. The goodwill is 0. That means the net asset, that is your equity, which is your net asset, your equity will still be 30 million. So shareholders equity, since there is no goodwill, the shareholders equity will be the same as our purchase consideration. So the shareholders equity is 30 million. Now that the shareholders equity has been obtained, then you also need the net asset. And you were told on the basis of the information provided that our net assets are equal to equity plus the loan. So that means the loans, I remember the loans, which is 10% loan notes. Remember, not current liabilities, current liabilities. In the note 3, that the director's loans account will be repaid, and it will be repaid by obtaining a loan of the same amount with interest at 10% per annum. 10% loan notes will be obtained. 10% loans will be obtained, which is of the same amount, which is 10 million. So that means the net assets will be 40 million. So the net assets will be 40 million. That is the meaning. Net asset or capital employed. Remember, the capital employed is shareholders equity plus the loans. So that is capital employed. So we've adjusted the financial statements as required. Then what further information is required on the basis of the information provided in the question? Calculation of ratios. So the first ratios given in the question is return on equity. Return return on equity, which is ROE. Return on equity, ROE. Return means profit. That means we have profit over equity. Profit over equity. Then the profit that goes to equity holders. Remember, equity holders are the owners of the company. They are entitled to the totality of the remaining profits after other stakeholders have been settled. That means the profit that goes to equity holders, that goes to shareholders' equity, is profit after tax, which is part over shareholders' equity. Shareholders' equity times 100 over 1. The part from our calculation is 6.5 million. How much is the shareholders' equity? The shareholders' equity amounted to 30 million. So we have 6.5 million divided by 30 million times 100. That will give us return on shareholders' equity. 6.5 divided by 30 million times 100. That is 21.7%. Since the answer, the existing ratio was taken to one place of decimal, so your computation too must be taken to one decimal place. So that is our ROE. Therefore, ROE, return on equity, equal to 21.7%. Then the second ratio you are given is net asset turnover. Net, that is number 2. If this is number 1, net asset turnover. Turnover means sales. So that will be revenue over net assets. Net assets. So since it is not given in period, it's not given in days, it is given in times. So you make use of the formula. But if it is in days, multiply by 365 days, unless otherwise stated. How much is our net asset? So from the question, the net asset amounted to 40 million. And the revenue given in the statement of profit or loss amounted to 70 million. That means we have 70 million over net assets of 40 million. 70 million over 40 million. That gives us 1.75 times. 1.75 times. That is the net assets turnover. The third ratio given in the question is gross profit margin. Gross profit margin. Remember, margin means sales or revenue. So which is gross profit over revenue times 100 over 1. So our gross profit from our calculation amounted to 20 million. We have gross profit of 20 million and revenue of 70 million times 100 over 1. Therefore, we have the gross profit margin of 20 million divided by 70 million times 100, or 28.6%. 28.6%. That is the third ratio. Then we have the fourth ratio. The fourth ratio is the net profit margin. The fourth one, we have net profit margin, which is the net profit over revenue times 100. Remember, I've told you your net profit is your total down one, which is profit after tax. which is 6.5 million. 6.5 million. Revenue of 70 million times 100. So 6.5 million divided by 70 million times 100. We have 9.3%. Therefore, net profit margin equals to 9.3%. We have calculated the required ratios for Oyo Wood Limited. For comparison purpose now, let me have the two ratios for comparison. For comparisons, we have a sector average. Sector average. We have for Oyo Wood Limited. So the first ratio is return on equity. Return on equity for Oyo Wood. From our calculation, we got 21.7%. For sector average given in the question is 22.0%. The sector average is already provided in the question, and this is the sector average. So information we have here, they are the sector averages. I'll be writing under the sector average. Then the second ratio computed is net asset turnover. Net asset turnover for Oyo Wood. From our calculation, we got 1.75 times. 1.75 times. For sector average, given in the question is 1.67 times. Then the third ratio is gross profit margin. Gross profit margin. From our calculation, we got 28.6%. And the industrial average given in the question is 30.0%. Then the last one is net profit margin. The net profit margin, from our calculation, we got 9.3%. And the industrial average given in the question is 12.0%. These are the ratios for comparison purpose. We've done with the requirement A. Now, back to the B part of the question. The question will find that you should draft a memo. In the B, you have to draft a memo for the consideration of the managing directors of Shinsom PLC, commenting on the performance of Oyo Wood Limited. So, we want to draft a memo and we want to comment on the performance of Oyo Wood Limited. In the B part of the question, you want to write a memo. So, let's have confidential memorandum. Confidential memorandum. Confidential memorandum. So in your memo, you will start with to, you have to write a memo to the managing directors of Shinsom PLC. So we have to the managing director, the managing director of Shinsom PLC. Who is the writer? You are the writer from, and you are the financial analyst in this question. Financial analyst. Then what are you have to write about? So you put that as the subject. That is the topic you want to write about. So acquisition of Oyo Limited, performance review and recommendation. Your subject should not be too long, so you should avoid lifting, absolute lifting from the requirements. So avoid lifting. So acquisition of Oyo Wood Limited, performance review and recommendation. Oyo Wood Limited, performance review and recommendation. This could be your subject. Then you must have a date. So this question is solved in year 2025 November, but since the year given in the financial statement is 2022, let's assume this report is written on the 25th of May 2022. So this is the date. Then you start with the introduction. Your introduction must start with the company. What do you know about Oyo Wood Limited? Oyo Wood Limited is a retailing company which is owned and managed by the same family, which is owned and managed by the same family. So you can start by saying Oyo Wood is a retailing company, and that is the information we could get from the question. It's a retailing company which is owned and managed by the same family. So that company now are the one that now presents an attractive acquisition opportunity for Shison PLC. So managed by the same family. Presents an acquisition opportunity. Acquisition opportunity for Shison PLC. For Shison PLC. This could be the introduction of the company. So what would your memo entail now? This memo provides an analysis. So we now want to give details about the memo. This memo provides an analysis of Oyo Wood performance, analysis of Oyo Wood Limited performance. You know, you have to analyze the performance of Oyo Wood relative to the sector average. Relative to the sector average. Relative to the sector average, highlighting key strengths highlighting key strengths. So the ratio will highlight the key strengths and areas for improvement and areas for improvement. This is the introduction part of the memo. Since these ratios are not many, I want to provide them as an attachment to the memo. But if there are many, you can have them as an appendix to your memo, and then you'll be making reference to that appendix in your write-up. So let me have performance analysis. We have sector average. Then we also have Oyo Wood Limited. Oyo Wood Limited. So the ratio we have return on equity. The first one, we have return on equity, ROE, 21.7% and 22%. 21.7% and 22.0%. Then the second one is net asset turnover. Net assets turnover. We have 1.75 times and 1.67 times. 1.75 times and 1.67 times. Then we have gross profit margin. Gross profit margin. We have 20.6%. Then we equally have 30.0% for sector average. Then the last one is net profit margin. Net profit margin. 9.3% and 12.0%. 9.3% and 12.0%. So now, let's have the keys observation, what we observed from, let's say, key observations. By key observations, I mean what we observed from the computed ratios. The first ratio is return on equity. Number one, return on equity. ROE. If you look at the return on equity of Oyo Wood, we have 21.7%, and that of sector average is 22.0%. That means Oyo Wood ROE is slightly lower than the sector average. Oyo Wood return on equity is slightly lower than the sector average. Or you can quote the ratio, but since it has been written here, that means quoting it is not necessary. But if you did not write it here, you need to state it. Oyo Wood ROE of 21.7% is slightly lower than sector average of 22.0%. What does this indicate 22.0%, indicating a marginally lower return for shareholders. That is what it means. Indicating a marginally lower returns for shareholders. That is for ROE. Number 2 ratios we have computed is net assets turnover. Net assets turnover. The net asset turnover. Now, if you look at the result obtained from our computed net asset turnover, that of Oyowood is 1.75 times, while that of sector average is 1.67 times. That of Oyowood is higher than the sector average. So what does that indicate? Oyowood assets turnover, asset utilization is more efficient. So it shows that Oyowood are more efficient in asset utilization. Oyowood is more efficient in assets utilization. If Oyowood is more efficient in asset utilization with a higher turnover ratio compared to the sector average, with a higher turnover ratio, with higher asset turnover ratio compared with the sector average. I told you have to be quoting the results obtained from those ratios and the sector average if you have not provided those ratios as part of your memo. You can say the net asset turnover. Oyowood is more efficient in asset turnover with a higher asset turnover ratio of, what is asset turnover ratio of Oyo? 1.75 times compared with sector average of 1.67 times. So, but since I provided those ratios are part of my memo, that is why I'm no longer quoting the said ratios. So the third ratio we've computed is gross profit margin. That is number 3. Gross profit margin. So let's check our gross profit margin. For Oyowood, we have the gross profit margin of 28.6%, while that of sector average is 30.0%. What does that imply? Gross profit margin, Oyowood gross profit margin is lower than the sector average. So it's lower. So Oyowood gross profit margin is lower than the sector average. I've told you where the ratios were not provided as part of the report, you need to state them in your memo. Oyowood gross profit margin of 28.6% is lower than the sector average of 30.0%. So, and then you have to make reference to the appendix that shows your computation. You can see appendix 1. So you make reference to the appendix. Now, what does this one suggest now? What does it imply? Since we have lower gross profit margin for Oyo Limited compared with the sector average. So what does it imply? It is suggesting potential pricing pressure or higher production costs. Suggesting potential pricing pressure. Potential pricing pressure or higher production costs. Higher production cost or higher direct cost, whichever one. So if your cost of production is high, it's extremely high, that could be as a result of inefficiency of management in applying proper control measure in controlling their controllable costs. So that could be the reason. So that is gross profit margin. Number 4, we have net profit margin. Net profit margin. Let's check the results obtained from our calculation. So the net profit margin of Oyo Wood is 9.3%. That of sector average is 12%. What happens? What can you say about the net profit margin? The Oyo Wood net profit margin is significantly lower than the sector average. Oyo Wood net profit margin is significantly lower than the sector average. With this lower net profit margin, what does this imply? What does this suggest? So it is indicating higher operating expenses or inefficiency of the management. Industrial rate indicating it is indicating higher operating expenses, or inefficiencies So it implies that the management are not efficient in their cost control. So that is what this implies. Now we've written our view about the 4 computed ratios. Then what could be our recommendation? You have to align your recommendation with your write-up. You align them. So what could be your possible recommendation? Considering your good performance, we recommend, let's say, considering Oyo Wood performance. You have analyzed the performance of Oyo Wood, considering Oyo Wood's performance, we recommend proceeding with the acquisition. We recommend proceeding with the acquisition. We recommend that they should proceed with acquisition, they should focus on this, focusing on the entity that is, what is the name of the entity? Shisum PLC should focus on the following. I've told you, you have to align your recommendation with your analysis, with your findings. So the first discussion, number one discussion, was return on equity. We said the returns that will be due to equity holders will be a lower return compared with the sector average. And this is as a result of the lower net profit margin. So what could be your recommendation now? The entity should improve the operational efficiency to enhance the net profit margin. So your possible recommendation should be improving operational efficiency. Improving operational efficiency. Improving operational efficiency to enhance the net profit margin. To enhance the net profit margin. That is number one. Our number two discussion is on net asset turnover. And we've concluded that the net asset turnover that Oyo Wood has a better net asset turnover. And this improved in net asset turnover for Oyo Wood shows a greater efficiency or a higher efficiency in the management or utilization of their assets. What could be the possible recommendation on that? The Oyo Wood should you should leverage in Oyo Wood's strong asset utilization to drive growth. They should try to maintain it. So number two, leveraging Oyo Wood. They should leveraging Oyo Wood's strong leveraging Oyo Wood's strong asset utilization. Strong assets utilization to drive growth. So our third issue, that was on gross profit margin. And we said Oyo Wood gross profit margin is lower than the sector average, suggesting potential pricing pressure or higher production costs. So what could be a possible recommendation? They should address pricing strategies. Addressing pricing strategies. Addressing pricing strategies to improve gross profit margin. To improve gross profit margin. So, in view of all we have said, this acquisition presents opportunity to expand Shisum PLC. This acquisition presents an opportunity to Shisum PLC to expand portfolio, to expand their portfolio, to expand their portfolio investment and create value through strategic management and acquisition. And create value through strategic management and acquisition. So, thanks. So, you put your name, XYZ. Thanks for watching this video to the end. In my next video, I will continue from where I stop in this one. Please drop the love emoji, like the video, and also share it with others. Thanks for watching, ican. Bye for now.